Well, I'm William Baldwin. I cover investing for Forbes, and I'm going to be talking today with an expert about closed end funds. This is going to be Erik Herzfeld, who is president and portfolio manager of a Miami Beach, Florida firm that does almost nothing but closed ends. They really know this stuff inside and out. So, Erik, I'm going to ask you a bunch of tough questions, but I'm going to start by asking you some easy questions. What is a closed end fund? Some of our audience don't know exactly the difference between that and a regular fund.
It's a question we often get. I think the main thing to think about is a closed-end fund is really just an open-end fund, a mutual fund, but instead of it being redeemed and trading, it trades basically on an exchange. So you can think of it as an open-end mutual fund that's actively managed, but that fund trades on an exchange. So instead of redeeming and getting in and getting out of the securities through an issuer such as MFS, for instance, you can buy and sell your shares on an exchange.
So Erik, what's the deal here? Most funds, exchange traded funds and open end mutual funds, the usual kind of fund, they always trade at net asset value, the value of their stocks that they own or bonds that they own. But these closed ends are kind of weird, right? I mean, they could trade anywhere, right? Why? What happens?
That's exactly right, Bill. I think the main difference is if you think of an open-end mutual fund, let's say we're talking about a big growth fund that buys shares in Apple and Microsoft. It's very easy for the portfolio manager to deal with the inflows and the outflows by basically selling and buying depending on the flows. There's really not a lot of slippage. It's easy for the portfolio manager. The difficulty becomes, though, if it's a mutual fund that's doing something more esoteric, emerging markets. As you can think of any type of crisis, we've seen many of them in our lifetimes. When everybody decides to sell at the same time, the portfolio manager is inundated with redemptions, and they have to go ahead and sell all their positions out, which that's not really great for really anybody. It's bad for the fund, the shareholders that want to stay in the fund, and it's bad for the portfolio manager because they have to sell things in the market. And the nice thing about, and really how closed-end funds started, was they were meant to be for emerging markets and things that are holdings that are a little bit less liquid. So you can think of it, instead of, if you want to get out of a closed-end fund, you can get out on an exchange. So there's always going to be a bid and an offer. There's always going to be somebody on the other side of the trade. In a mutual fund, it's if the portfolio is illiquid and the portfolio manager has to get out of shares, or it's really difficult. It may move the price quite a bit in stocks. So I think what you think about as a closed-end fund is really providing liquidity for investors, and it doesn't take anything away from the portfolio manager that can continue to hold the position. So I think that's really the big difference, is that you're affording the buyer of a closed-end fund liquidity, and then that leads into the idea of trading at a premium or a discount to net asset value.
I see. So when I get in or out of a closed end, I'm really buying and selling secondhand goods. And that
That's correct.
means that depending on supply and demand, the price that I get or the price that I pay could be way out of the baseline. It could be way away from the net asset value. Can you give one or two extreme examples of a fund trading at way more than the liquidating value of its portfolio, or a fund trading at way less?
There's many examples. In fact, if you think about it, the idea that a closed-end fund can trade at a premium or a discount gives you a sense that not always is the price equal to net asset value. In an ETF, we do often have, most of the times, there's a mechanism, an arbitrage mechanism, that keeps the net asset value and the price almost the same. In a mutual fund, as we mentioned, you're getting in and out at the net asset value. So by definition, the price equals the net asset value. Your example, Bill, is exactly right. So there's many different funds that trade at discounts. In fact, many different bond funds at the current moment are trading at big discounts. Many equity funds are trading at discounts. One of the examples is Central Securities Corporation. This is a fund that's trading at a 20% discount to their net asset value.
Well, that's also an interesting. By the way, I might think of that as being a good stock to own. Maybe, maybe not. Maybe you're not offering an opinion on it. But if our audience looks that up, they're going to find that 20% discount. And if they look deeper, they'll see one of the great reasons for owning a closed end, because this thing has a big position and a very illiquid stock. The stock that it owns is Plymouth Rock Insurance, and boy, that thing is on the balance sheet at a low number, but it's probably worth a whole lot more. However, if this were an open-end fund and the manager had to sell all, he couldn't sell this thing. It's privately held. It's worth a lot of money, but he can't dump it. So that might be a very interesting example of an illiquid stock in a closed-end fund. Now, Central Securities is liquid, because if I own 100 shares of that and I go and trade, what does it trade on the big board?
That's right.
All right. So if I want to put in a sell order at 100 shares of Central Securities, no problem. A buy order, no problem. There's plenty of liquidity in Central Securities. And if I'm buying, yeah, it's pretty cheap. What's an example of a fund trading at a premium? You know, it's got $100 worth of securities per share, but you have to pay 110 for it or more. What's an example?
Premium funds are out there, and usually people buy the funds because it offers something that they're really keen on, and specifically, it's usually funds that are esoteric. I think, as you can recall, there was a few funds that were investing in Bitcoin, and they were trading at premiums for quite a while because it was hard for the general public to access Bitcoin. So they were buying it in the closed-end fund format. And this is GBTC is one example. That fund trades at a discount, but it did trade at a premium. Another example of a fund at a premium is the Gabelli Utility Trust, GUT. And that fund is trading at a premium. It's been as high as 100% premium. And it trades at a premium because the idea that investors can hold that fund and then still get quite a big dividend. And many times the distribution is actually a return of capital. It's a little bit more esoteric, but basically it's a very, very high distribution rate. That very high distribution rate really gets investors very interested to hold it, and it pushes the price to a higher premium. The closed-end fund industry is about $210 billion. I think it's one of the things where closed-end funds actually outdate mutual funds. They predate them, and they're originally created to invest in emerging markets. One of the earliest funds was in the late 1800s, and it was a Dutch fund. It was a Dutch closed-end fund, and one of the emerging market positions it held was the United States of America.
That's well, correct. I guess I can't roll the clock back to 1890 and buy that great stock. But the one you mentioned earlier, Central Securities, didn't that open like 2 weeks before the great crash of 1929? Bad timing, right?
Exactly. Well, it could have been really good timing if you think about it. If they launched it and raised all the capital a week or two before the crash, they can go out and invest in everything was extremely cheap. But I think one of the things that, as you mentioned, the entire net assets of the closed-end fund industry, it's not even a small fraction of the cash that Apple has on its balance sheet. Even though 1 in 8 stocks that trades on the big board is a closed-end fund.
It's astounding. 1 in 8. Wow.
Yeah, it's about 1 in 8. And they don't trade a lot. A lot of times investors, they buy and hold them. They're holding them for yield. And they're longer term, they're actively managed, funds. And they're just not traded as much. And given the fact that they're closed, they don't really grow like ETFs or closed that are open and funds. So the fact that they don't grow, and they're also required to pay out almost all of their income. So you can think of it, everything's getting paid out in the form of a dividend. So it's really hard for them to grow. So for many, many years, the industry's actually not grown at all.
I see. Well, that maybe plays into your hands because you're trying to find hidden bargains, and you're avoiding, of course, all of the overpriced things that cost twice as much as they should. So discounts today, what do they average? And how does that compare with, 5 years ago or 100 years ago or 10 years ago?
The average discount of all the industry right now is about 9%. So you can think about, 100 cents, you're paying 90 cents on the dollar for an average closed-end fund. And different funds have different discounts. And this has been ever since the beginning of time. Whenever you have a very in vogue or very hot sector, tends to be a lot more demand, pushes the price to a premium. And then conversely, whenever you have something that's out of favor, like right now, fixed income is almost a dirty word. As you know, we're about to hit 5% in the 10-year. A lot of investors are quite apprehensive to own anything that says fixed income in it. Even though the funny thing is that most of the fixed income funds, the closed-end funds that is, they're not really fixed income. They're actually floating rate. So it's actually really, in many cases, a very good bargain to hold these closed-end funds at a discount.
I see. Well, you have to be careful. You have to look at a lot of things. You look at discounts, you look at premiums, you look at yields, you probably look at liquidity. Maybe you don't want to be in a very illiquid closed-end fund. Do you ever look at the management cost of a fund? I mean, maybe some of those discounts are deserved because the managers are pulling down big fees for doing not much good for me.
That's right. That's exactly it, Bill. So many times, so there's about 20 different factors that we look at. We take apart the fund and we deeply dive into the nuts and bolts of where, how is the manager? Because remember, these closed-end funds are managed by portfolio managers, just like an open-end fund. Conversely, an ETF is a passive, right? So it's just basically a formula. In this case, there's real people behind it, and they're making real investment decisions. So you really want to pay particular attention to who the pilots of the fund, who's flying the aircraft, so to speak. And then you want to, just like an airplane example, you want to think about, what's the cost of the fuel on board? What is it carrying? What's the range of the aircraft? What's the price to get on the aircraft? All these things matter. And I think at the end of the day, there's about 20 variables, as I mentioned. Expense ratio is very important. As you mentioned, in municipal bond funds, if your expense ratio is 4 or 5%, I mean, that's quite a wallop of a fee. You can go out and buy a Vanguard or a BlackRock ETF or a low cost, no load mutual fund and pay very, very little expense ratio. And so it really depends. Many times the discount can warrant and actually be quite justified because it's such an extreme level. But if you're talking a 10 or 15% discount, it's not warranted at the moment.
Well, hopefully we'll find some way to make a lot of money in this interesting and complicated sector. More research is needed, I think we'll have to tell our audience. They want to buy a fund, they should look at a lot of different angles before they put in the buy order. Thank you very much, Erik. This has been a fascinating discussion, and I hope the field gets a little bigger, because that would give me more opportunities to make money.
Actually, thank you very much, Bill. We like it just the way it is because it really favors the smaller investor that's willing to spend the time and the due diligence to kind of find those opportunities. And it is a really interesting field. We specialized in it for over 40 years, so we like it just the way it is.